Take a look at this chart. It shows us the price structure of gold before it went on a 100% rally in just a year and a half. Leading up to that move, gold had been consolidating in what's known as an ascending wedge. This is a formation where price keeps rising inside two converging trend lines, with each move getting tighter and tighter, signaling compression until price breaks out in either direction, resulting in a big move. We can see that when gold finally broke above its ascending wedge resistance in March 2024, it triggered a parabolic ascent. Now, if we look at Bitcoin's price action over the past few years, the structure looks almost identical. Once again, we've seen Bitcoin move between this rising support and resistance, building a similar kind of compression. If Bitcoin were to follow the same blueprint as gold, it would suggest that we're about to see the most aggressive phase of this bull market heading into year-end. And believe it or not, gold is already telling us the exact timeline for this type of a move, as we'll show you later in this video. This resemblance between gold and Bitcoin isn't just technical, but also structural. You see, Bitcoin has long been perceived as digital gold. It's a modern store of value built on the same foundation that supported gold for centuries, namely scarcity, durability, and independence from any single government. That narrative gained powerful validation in institutional circles when Larry Fink, the CEO of BlackRock, publicly described Bitcoin as digital gold. This, coming from the world's largest asset manager, framed Bitcoin not just as a speculative asset, but as a legitimate hedge within the same macro framework as gold. And the core reason behind this comparison comes down to a major driving force significantly influencing both assets, something known as currency debasement. To understand this concept, let's look at what currency devaluation actually looks like. In the 1920s, a typical home in the US went for $6,300. Today, that same home averages around $420,000. A dozen eggs went for 13 cents back then. Now, it's shot up to $3.59. And a loaf of bread went from just 5 cents in the 1920s to $1.84 today. The products themselves haven't changed much, but the dollar's value clearly has. We can see this more clearly through the long-term chart of the US dollar's purchasing power. Over the past 100 years, the dollar has lost 97% of its value, and in just the last 5 years, it's lost 20% of its purchasing power. That means if you had saved $100 in 2020, it now buys you only $80 worth of goods and services. So in simple terms, it takes more dollars today to buy the same things you could have just a few years ago. This consistent erosion of currency value is what's known as currency debasement, and the core driving force behind it comes down to US debt. In the 1790s, America's total national debt stood at just $70 million. By 1982, that number had reached $1 trillion. So it took the United States nearly 200 years to reach its first trillion in debt. Since then, it took only 43 years for debt to surpass $37 trillion, and the pace only seems to be accelerating, with just the last year alone seeing debt rise by more than $2 trillion. What once took 200 years now happens twice in a single year. This exponential rise in debt is the clearest reflection of why the dollar's value continues to erode. Every new round of borrowing dilutes the purchasing power of existing dollars, fueling the very debasement that investors are trying to protect themselves from. Both gold and Bitcoin have been reacting to this phenomenon, a shift that renowned macro investors like Ray Dalio and Stanley Druckenmiller are calling the debasement trade. This has also been a core pillar of our investment strategy at Bravo's research. We've made consistent gains from assets that benefit the most from this ongoing currency debasement trend, including profits of 27% and 49% from leveraged long positions in gold, and several double-digit gains on Bitcoin when the technical setup looked favorable. If you want to have access to all of the trades that we're making, including stocks, commodities, and cryptos, make sure that you are a Bravo's member using the link below. At its core, the debasement thesis states that when governments take on too much debt, the currency loses value, and investors move towards scarce assets that are not tied to any one government's balance sheet. Gold has served that role for more than 5,000 years. Its supply grows slowly, at 1.5% to 2% per year. It carries no counterparty risk, and it's accepted worldwide. That's why central banks from China, Poland, India, and other large institutions have been aggressively buying gold as a way to diversify away from the US dollar. Bitcoin, though only 16 years old, was built on the same principles as gold. Its total supply is capped at 21 million coins with a 0.8% supply growth rate that's cut in half every 4 years through the halving cycle. Bitcoin also carries no counterparty risk and has been seeing increased adoption in recent years. For instance, nearly 12% of all Bitcoin is now held by public companies and institutional investors. So gold's scarcity is geological, while Bitcoin's is algorithmic, but both are being driven by the same underlying force, which is the gradual erosion of trust in government-issued money. That's why, when we look at the price chart of gold and put Bitcoin on top, we see somewhat of a close relationship between the two assets. For example, both assets saw a sharp drawdown in 2022 and have been moving higher since 2023 onwards. But so far in 2025, gold has already gone up by over 55%, while Bitcoin has mostly traded sideways. While investors would be quick to call this a broken relationship now, we actually think it reflects two key factors that influence how these assets move in relation to one another. The first factor is the strength of the relationship between the two assets. This chart shows the short-term correlation between Bitcoin and gold since 2020. In simple terms, correlation measures how closely two assets move together. A reading near 1 means they move in the exact same direction, while a reading near -1 means they move in the exact opposite directions. As we can see, the short-term correlation between the two assets has fluctuated heavily over time. There are periods where it crosses above 0.75, showing a strong positive relationship, and there are also moments where it dips below -0.75, indicating a strong inverse relationship. Now, if we shift from short-term to a longer-term correlation, the picture looks very different. We find that for most of the past 5 years, this correlation line has stayed above 0, showing that Bitcoin and gold have generally moved in the same direction. Of course, there are still brief phases where that relationship turns negative, but those periods tend to be very short-lived. So by comparing the short-term and long-term correlation charts, we see that the two assets can often diverge significantly in the short run. But over a longer time horizon, they tend to move together within the broader macro cycle, driven by the same theme of currency debasement that we discussed earlier. The second factor at play is the lag effect. You see, gold and Bitcoin don't typically move at the exact same time. Gold, supported by steady central bank demand and established credibility over thousands of years, tends to move first. Bitcoin, with its growing treasury company inflows and accelerating institutional adoption, often follows with a delay. If we take the price chart of gold and Bitcoin and shift gold's line forward, a clear pattern emerges. Gold has historically led Bitcoin by roughly 3 months. Of course, there's no guarantee that this relationship will continue to remain true in the future, but if it continues to hold today, gold's latest breakout suggests that Bitcoin could find a bottom by November 2025 before entering an aggressive ascent over the next 3 months. So, in essence, what gold has already done, Bitcoin is now likely preparing to do. And we're actively looking to position ourselves in anticipation of this rally, while following our strict risk management framework. We've been taking our clients step by step through this crypto bull run, sharing our trade setups and trading strategy through 3 weekly premium videos. Our approach has helped us secure multiple double-digit wins, while keeping most of our losses limited to around 5%. If you want to follow all our moves in real time, make sure to join us using the link in the description below.